Hello everyone, thank you so much for joining us today. My name is Greg Lewis. I'm the marketing manager for MetaStock, and in precisely 4 minutes and 36 seconds, we are going to start our main presentation, which is Martha Stokes discussing how to trade in volatile market conditions. First, let's watch a video.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar Oscillator System, or simply known as the RMO. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Okay, thanks so much for watching that. We now have about 45 seconds until we begin. Really quick, we have a summit that we've just launched the schedule for. If you go to metastock.com and click on the banner at the top of the page, you can go to that summit and see all of the 8 speakers. I believe it is on June 24th. Go check that out and register for sure. And also don't forget to like and subscribe for today's like and subscribe for YouTube so you can be notified of live events like this coming up in the future. And also make sure, of course, that you comment and participate. We really enjoy that. Martha is a really great speaker, and she has really great answers to your questions. And right now, I think it's just about time to get started. Thanks so much for joining us, and successful trading.
Thanks, Greg. I love the countdown too, by the way. It kind of lends to some officialness to the whole thing. Thank you, Greg, for kind of helping with all of the YouTube stuff and the videos and all this stuff. You do a great job. Certainly appreciate it. Well, I say thank you for coming. It's good to see you. My name is Jeff Gibby. If you're watching this video now or in the future on YouTube, I would appreciate it if you like and subscribe. It helps a great deal. It's good to see you. We have a great presenter today, and we're happy to have her. So, in any case, it's good to have you. As we go, if you have questions, make sure to ask them. You can do that if you're going to GoToWebinar. You can do that in the questions area. It's off to the right-hand side of the screen. You should be able to find it. Just click on there. It's not an unmoderated chat. You just click in it. If you have questions on YouTube, just ask them in the chat area. That's the best place to get them to us. All that kind of good stuff. So let's go ahead and get the legal disclaimer out of the way, and then I'll introduce our guest and we'll be off. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Now, I just realized that this is kind of a little bit of an older disclaimer. We've actually added a part where we also make it clear that we're not endorsing any securities today. We're not paid to endorse any securities. We're not compensated to endorse any securities. Typically, like the goal for the sessions that we do is primarily designed to help you get some really, really good education. So with that in mind, today's guest is Martha Stokes. Martha is a friend of MetaStock. She's been working with MetaStock for a number of years. She's a CMT, which means Chartered Market Technician. She, I don't know how long we've been working with Martha, but I remember it's been some time since I visited her at the TechniTrader offices up in Washington. It was a great visit. I've always been very, very impressed with the work that Martha's done over the years. She's developed her own custom indicators in MetaStock. The work that she does is typically designed to kind of help you understand what's going on underneath the market, or kind of what's happening inside of a stock. And I think her contributions personally to technical analysis have been immense. And so I was happy to have her in here. It's been a minute since we've done a focus session on her. So I invited her in, and I'm looking forward to having her in here. With that being said, Martha, let's go ahead and get you started. How are you doing today?
Hi, how are you?
Good, good. Did I miss anything important in the introduction?
I'll just gloss over it. You haven't missed anything, so thank you very much. Well, I was up till midnight working on this book. I was up till midnight working on touches and things, because this is a special type of webinar. This is a webinar where I'm going to be giving you a lot of education, a lot of information that you may not have thought of in this way before. And I love to teach. So I'm so excited, because this is like, oh, this is good. And that doesn't necessarily always happen every time I write a webinar and present it. But this time, yeah, it is good. And
I'm sorry, Martha. It's always good when you do it with us. I haven't seen a bad example. But
I have a disclaimer too. But I want you to take notes. I want you to try, if you feel comfortable, to be interactive with me and ask me questions or respond to my questions, because I'm going to be asking some questions. So this is the disclaimer. You all know, I've seen them before. And what we have is my credentials: Chartered Market Technician, member of the CMT, and approved for SEC Series 86. This is very important, because a lot of people are out there. There's thousands of them that are trying to sell their ideas, their theories, their strategies, their psychology, and this type of thing. The SEC is going to require that almost everybody that presents like I do have a Series 86 in the future. So this is going to be one of those things. I've been teaching for 26 years. I retired very early. I thought I sold my trading floor, and I thought I was done. But my business partner, Howard Johnson, said, "Oh, we should teach, because I know you're bored. It's been a year, and you've been retired for a year, and you're bored." And it's like, so I finally sequestered to what he wanted to do. So I have two professional doctoral theses that have been approved by the SEC, and the CMT organization as expanding the body of knowledge of technical analysis, cycle evolution theory, how to identify evolutionary cycle deviations. I have a course for my students on that, and relational technical analysis, which I also have a student course for my students. So we're going to talk about volatility today, because everybody's going, oh, the market is so volatile. I can't make any money. Oh, the recession is coming. I am so tired of hearing the CEO of JP Morgan say that a recession is coming. It's not even funny. No way, no how. What does the term volatility mean for the stock market? You can type in your answers to Jeff if you want. So what does it mean to the stock market? What do you think? When you hear the term volatility, what does that mean to you and your trading? What does that mean? How do you react to that volatility? How do you react to the volatile markets? What do you do? How do you trade them? How do you trade them successfully? How do you manage it? Where does volatility come from? It has to come from something. It has to come from something. It can't just suddenly appear out of nowhere. The stock market is just follows the science of physics, just like everything else on this planet. How do you know if the market is volatile or if it's just hype? It's just somebody spouting off like CEO of JP Morgan saying recession is coming, because he wants the market to go down, because he makes more money selling short and buying to cover than he does buying long with his trading floor. That's just the reality of it. The term volatility market is a commonly used term and is predominantly on the retail side of the market. I don't hear it on the professional side at all. Don't hear it. Volatile from the dictionary means this: likely to change suddenly and unexpectedly in situations that are getting worse. Okay, but I find that very curious, because most of the time when I see the extensions on the stock, the candlestick patterns, the indicators that I have, I say, okay, folks, we're going to have a little minor correction. We may go into an intermediate term correction. So I'm never surprised by the market. The VIX is a volatility indicator for downside risk. It is an indicator. That's all. So this is a part of the VIX that Jeff sent me from the internet terminology. So the Chicago Board Option Exchange, CBOE, Volatility Index was created and owned by CBOE Global Markets Incorporated, CBOE, in 1993. Well, that was a very different market than we have right now. I mean, completely different. We didn't have dark pools. We didn't have off the exchanges. We had more public exchanges. Everything was transacted. You could see every transaction, even the large lots, coming through your level 2 screen as a day trader. Total visibility. That's not there anymore. It's all gone. So simply referred to as the VIX, it is a market index indicator, When I studied for my CMT, I studied 277 different market, stock, and economic indicators, because I wanted to make sure that I had all the knowledge I need and that I could pass my tests with flying colors. Market index indicator that measures the implied volatility. We hear implied volatility all along. What does implied mean? Implied means that we're suggesting that this might happen. Okay, it is not cut and dried that it is happening. So the S&P 500 index, also known as SPX, is the core index for the US equities, because it's the largest one that holds all the Fortune 500, top 500 companies in it. And so it is the major index that professionals and retail traders should use, because it has all of those in. The VIX patterns attempts to measure or indicate the magnitude of price movements of the S&P 500, which is assumed to be the volatility of that index. Attempts to indicate the magnitude of price movements. This is from the internet. It should really be value movements, not price, but I just took it right off the internet. So you can see that. And the more dramatic the price swings are in the index, the higher the level of volatility, vice versa. So this would say that there's high volatility and it's heading to the downside, and then suddenly the volatility drops because, oh, the S&P moved up. Now I have these two, and I'm trying to show you that the high volatility shown on the VIX doesn't necessarily reflect in the S&P 500. These are the same time frame. So what we're going to do is we're going to make a line indicator out of both of these, because this doesn't show you graphically what I want to show you. Okay, so we have the VIX. We have the S&P 500. Clearly, the VIX is an inversion of the S&P 500. However, this is a soft intermediate correction. This is not a major meltdown. And then as the index starts to run up and move up and up and up and up, then we have this low volatility that's showing tiny little measures up and down as the index moves up and down. See how that works? See how lovely that is, that you can see that? And then we have another minor short-term correction, and the VIX goes ballistic. It was written in 1993. So what do you think is the problem here? I love indicators. I know a lot about them, and there's a problem with this indicator. What is it? Does anybody know? It's too extreme. It is implying extreme changes to the S&P 500 when they are not extreme. These values should pretty much match. If this indicator was working properly, this would be lower. This would probably be the highest it got, and then it would trickle down. This is way too high. It should be much lower because this is a minor correction. So the VIX is in today's 2024 market is overemphasizing or implying the downside risk and the downside volatility of the S&P 500. So if you're following the VIX and you're an options trader or you're a day trader and go, oh, look at all this volatility, ooh, let's sell short. You're going to be in trouble because it's not as severe. So this is something you have, using the VIX is great. I look at it periodically, and you may want to use it more, but you be aware that it overemphasizes and exaggerates the actual magnitude of the downside. Okay, that's very important. Volatility, myths, and misinformation. The VIX was created in 1993. I want to repeat that, as a means of attempting to forecast or measure the magnitude of price movements of the S&P 500 stocks to derive the potential of the negative or downside momentum movement for the SPX. So it is a negative or a reverse thing. It's looking for the downside, not the upside. It was intended primarily for options trading in 1993, but rapidly became popular among retail day traders of that era in 1998, when everything went online, and all of a sudden you could trade stocks with your online broker, which was never possible before. You used to have to call a broker up to place an order for shares of stock. It is not an absolute or infallible, nor is it a predictive tool. It is not a predictive tool. I want you to write down predictive, and then I want you to put it across it, and I want you to stop using that word. Why? Because that word is telling you that that's an absolute. Predictions are absolutes. This is going to happen. A recession is going to happen. It's not going to happen, okay? Not going to happen. There's many reasons why. But it is too often used by retail traders as the holy grail. The reality is that implied volatility can be distorted in the 2024 stock market. Why? Because in 2002, we went from fractions to decimals. Think about it. Fractions, 25 cents, 50 cents, 75 cents, a whole point, a whole dollar, okay? There were all kinds of, you could scalp all day long as a day trader. Woo-hoo-hoo. You can't do that anymore because you have penny spreads, tiny, and the public exchanges are highly illiquid. HFTs are allowed on there because they provide the maker-taker role to provide the liquidity so that the public exchanges can function. If the HFTs weren't there and the pro traders from the sell side institutions weren't there, it would really be even more unliquid because the dark pools control all the activity off the exchanges. I'll go into that a little bit later. So we have to understand that implied volatility is exaggerating and distorting information that you may be using. Now, that may be a hard thing to swallow because we can get very attached to our indicators. We can get very attached to something, but you have to let it go. You can use it, but you have to know that a lot of times it's not going to be extreme because we no longer have the fractions and the huge swings like that. We have a different type of price pattern. Professional traders use option puts extensively to mitigate risk factors in a velocity market condition. We're going to talk about a velocity market condition. It's different than volatility, but a lot of times the VIX or other traders will assume that a velocity market is a volatility market, and it is not. Also, it is obvious when comparing the side-by-side S&P 500 to the VIX chart that the stock market of 2024, the VIX often distorts the actual volatility factor. So that is a fact that you have to go, okay, that's new, but I think I can grasp it. At times, the VIX distortions are extreme. So you have to, what that means is the current value changes to the S&P can and frequently are not as extreme or negative or volatile as the VIX indicator. So what do you by that? You think, okay, so if it's more extreme than it should be, it's indicating more extreme action, and I'm thinking, oh, I'll sell short, or maybe it's going into a quiet mode, and you're thinking, oh, well, there's nothing to trade because it's such a low volatility when actually the trend is going up strongly. So it works both ways. So pay attention to that. It is an indicator, and all indicators work optimally in specific market conditions, and so does the VIX. Some indicators give false negative indications. Stochastics in a velocity market or a moderately trending market will float above its high line and just float there. So you'll see it floating and think, oh, that means that we're going to have this downside oscillation of price, and it doesn't happen. And so it can be very problematic, or it can be on the low side, floating on the low side, and you're thinking, okay, it's going to go up, but it doesn't. So there are false negative indications, and you have to pay attention to that. VIX has that built into it just because of how old it is, and it hasn't been modified. So we have to watch that. So let's talk about volatility versus velocity. Volatility is sudden changes in price run, also known as trend direction, on a short-term basis. So volatility is a sudden move down, but typically you would be able to recognize with certain indicators that you would say, uh-oh, they're going to start taking profits. And HFTs gapped this down and ran this down. So HFT, understanding how the HFTs function and everything is critical to today's market. HFTs didn't exist in the 90s. They didn't. Volatile price fluctuations can and do occur on intraday price, day over day price, and even weekly charts can reveal volatile price that is shifting from the upside price trend to a downside price trend or run down. So you can check them on different time frames and see that there is a potential for a run down. This is a minor rundown, but the VIX would overemphasize it. Velocity is also up or down, but is an extended price movement that can and does often last for several days or longer and goes higher and higher. And I can assure you in the next couple of years, you're going to say, how can a price go? I mean, GME, look at that price. Huge swings in the day. Velocity may appear on the VIX as potential volatility when it is not necessarily negative. So you have to watch it. You'll be seeing that volatility rising on the VIX, but it's also a velocity move, and velocity can go further than it's irrational euphoria and speculative trading that gets out of hand. It does collapse, yes, but there's a way to watch that velocity and get in on it and then see the pro traders, little tiny profit-taking days, and then, okay, it's time to get out. And also there's the indicators that peak at the top of the indicator bar, and then that tells you, okay, that is the day to exit. So there's things that you can do that way. Velocity creates runaway trendline patterns and stair-step trendline patterns. And the runaway patterns just go and go and go, and they don't really correct. This is a type of a runaway trendline pattern that just keeps moving, but it keeps moving up. There's little minor, tiny corrections. But the idea is this is a nudge, get in with the pro traders and ride this up, and don't just take one day profit, but take several days profit. Instead of making $200 a day, you can make $20,000. That's the difference. These patterns have minor resting day candles patterns or tight consolidation patterns. So these are minor resting day patterns. It's just resting. It's just resting. It's just resting. It's just going. Okay, now we had some heavy selling, but it kept on moving up. Another low selling day. So we know we're going to add two warnings right here. And we would, the other indicators I don't have up here, would tell us, okay, time to sell and take our profits off this stock because it's going to retrace more deeply next. that's the type of thing that I teach my students. So foundational knowledge, if you've watched a lot of my webinars before, you probably know this already, but I'll go through it real quick. There are 6 primary market conditions: bottoming, platform, moderately trending. That can be a moderately trending up in a bull market or down in a bear market. Velocity, and that's in a bull market or bear market, up or down. Topping market and trading range market. We're going to visit all of these today. Each market condition is unique. The trends, the trend line patterns, stair step, runaway, that type of thing are different in the different market conditions. Platform market is all sideways. This is because different market conditions are created by different market participant groups dominating and controlling how price moves up or down. On any given day, at any given time, someone is in control of price. Someone is controlling price. The retail traders may get in at the last, and they're in control of price. They're moving the price up and up and up. And then the pro traders start selling because they were in control of price when they did the nudge that caused the HFT to gap and run. I've seen a lot of people that try to chase the HFTs, and that's a bad idea. You really need to get in with the nudge from the pro traders, because then you know, okay, the pro traders have control of this price at this time, get in a day after them, and then wait. And then HFTs will gap it up or down, and then you can go further with that, and then get out with the resting day candles, which are always the pro traders. The pro traders trade on the penny and half penny. So they're striking the penny. So their price action is extremely tight. That's why price is so tight and choppy so often. Market condition is your weather forecast for navigating the market activity. So we have climate, and this is the climate of the market. It's a bottoming market, it's a platform market, trading range, whatever. So I'll ask this later on, but what market condition do we have right at this moment? The S&P 500, the index, all of the broad base of stocks, the 10,000 instruments that we can trade on the stock market in the US. Which of one of these is it? We'll return to that in a little bit. You will trade differently in a velocity market than in a platform market. Why? Because velocity is running like a bandit upward, but platform is going sideways, 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 and then all of a sudden gapping up suddenly. And that is because dark pools are in control of price. And then all of a sudden they let everybody know, oh, we accumulated this stock. So then everybody is racing to buy it, just like retail gurus and retail famous TV celebrities say, oh, I bought this stock. I think it's going to go up. What do? You go buy the stock. Of course it's going to go up. Yeah, no prediction there. The stock market cycles, and each market condition is different part of that cycle. So learning how each market condition creates specific trading conditions helps avoid assumptive trading that results in losses. A lot of times you take a loss just because you assumed something rather than knowing something. Sometimes the market is called volatile when it is actually just choppy with intraday whipsaw action, which is common and ordinary for that market condition. There are certain market conditions where all of you should have 2 trading styles. Intraday is a trading style. Day over day is a trading style. Swing trading is a style. Momentum is a trading style. Platform position trading, intermediate trend, they're all styles. Then you apply the strategies. When this happens, calling the market volatile creates the wrong mindset and attitude when trading stocks, no matter what trading style you are using. So you have to be careful. Also, TechniTrader Market Condition Analysis, which is my creation, and I'm very proud of that, it's in MetaStock charting software, is completely different than the market conditions based on the VIX, the Dow, NASDAQ 100, S&P 500 indexes. That's one kind of what's going on. So I always say market condition for the indexes, market condition for the broad base of stocks, because they're 2 different things a lot of times. Most market conditions are seldom volatile in a bull market, but volatility measurement may give a false negative signal. It's tough to trade a bull market and sell short. It is important to first identify what market condition is dominant for the broad base of stocks and not just the 500 index component stocks, which account for less than 8% of all the listed stocks you could potentially trade in the US market. There's a lot more than the indexes, and the dark pools are always buying these really good startup new tech companies. They're doing it right now, and that stock takes off as pro traders find it. When you start your daily analysis of market conditions, which then define trading conditions, you will be able to properly assess what is occurring now on this day with the majority of stocks you could choose to trade. Don't have to worry about volatility. When you understand the trading conditions within the market conditions, then you are able to select stocks to trade with a higher degree of probability of success. Never predict, because predict makes you think that it's an absolute. There are no absolutes in the market. It is this fluctuating, flowing current of a vast $143 trillion in assets under management worldwide. So I'm not going to go very much into this because you've already heard about this, and most of you use this. And throw it out the window. It doesn't exist anymore. It was great in 1890. It was great in the 20s, but it doesn't exist in the 2024. The bull market cycle has buy-side institutions. They buy bargain price stocks. They'll buy at the bottoms. They'll form platforms as it moves up. This trend line can be daily. It can be weekly. It can be monthly. It can be annually. This is what happens. For our wealthy private investors, we have all these Fortune 500 CEOs, and they're wealthy. They started their business in some little shop or something, and then they made billions and billions of dollars. They know what they're doing. They're businessmen. Why do they know more about the market than any of us when they just owned a Fortune 500 company? Because the market is the business of businesses. That's all it is. Let's buy and sell businesses. The better the business is doing, the more money we will make. Professional traders on the buy side do more trading for the institutions to improve the return on investment. So for those mutual funds or ETFs, they are making more money because the professionals can trade. They have big, huge floors, huge floors. Any idea that floor traders are out? No, they can't get enough floor traders. I am training and teaching so many floor traders. It's amazing. Professional independent traders. JP Morgan said, all of you have to come back. You can't work at home anymore, And the floor trader said, no, we're going to stay home. We make more money on our own instead of what you sell us on a commission basis. Sell-side institutions also have huge floors. Sell-side institutions are mostly banks and Goldman Sachs and other companies like that. So they are short-term. These are long-term. These can be long-term or short-term traders. They're all on the professional side. We have corporations. They can invest in a small company. They're investing in companies on the NASDAQ private market. Have you heard about that? Super cool. It's a nesting guys beyond venture capital where they can be traded. Buy-side institutions are investing in these little small caps that are still private. Then when they IPO, you see this dot across the screen. That's because that stock was in the NASDAQ private market before it became public. A great way to present more private companies to public IPO that will be good for us to invest in. High frequency traders and hedge funds are on the professional side, but they trade the retail side. They provide the maker-taker roles and the market maker roles, and they are the creators of all the huge gap ups and gap downs at market open. They fill the queues with tons of orders, and then they sit back. And then when all the retail and smaller funds are buying, seeing that huge gap, oh, that stock is going to go up and up and up, they start selling. So do the pro traders, and they get in end of day. Last 3 minutes of the market trading day on the professional side is called the auction, and they are trading stocks heavily. So not all your selling, all your transactions will occur at the end of the day. You got to wait to look at your charts and your data to see it as about 2 hours before all of it is cleared in the national clearinghouses, because the buy-side institutions delay their orders as they are approved to do until after the market closes. So nobody can know what they've been doing all day long. So on the retail side, we have all these little groups, and they come in and they do all kinds of different things. And they are all very inexperienced. They don't have a lot of education, although they try very hard. And they are emotional traders, and they are less educated about what happens on the professional side. So everybody wants to be on the US stock market. The stock market is the largest in the world. If you add all the other 200 stock markets in the world together and combine them and compare it to the US stock market, we're still this gigantic behemoth thing. And we are that in all the financial markets. So where do you want to be in the next 20 years, next 10 years? You want to be in the stock market and all the financial markets of the US, because that's where the money is. 80% of all the market activity is on the professional side, hidden in dark pool ITS venues. You can't see their activity. I don't care if you have a level 2 or what, you can't see it. And somebody's saying, oh, there's a whale that's coming through. Oh, 100,000 share lot. Woo! I'm just laughing. 20% of the market is retail side. The professional side, independent traders are swinging 1 million to 5 million share lots at a time. Okay, that's the average. Okay, so 1,000 share lots is nada. Okay, bear cycle going down. We're not in the bear market, so I'm not going to cover this very heavily, but we can see that it inverts. Buy sides are selling before the peak. Sell side institutions are the sell shorters, and they will put their buy to covers really low. So will the professional traders, high frequency traders. Sovereign funds will get out someplace in here. Smaller funds groups are still buying, start buying on the dip here, but then they capitulate later on. Retail traders get in late because they don't realize they're in a sell short situation that they should have taken action in sooner. And chat groups and memes groups and small lot investors capitulate and give up and sell at the lowest price. And the buy side institutions, dark pools, are buying a bargain. They don't buy cheap stocks, but they do buy bargains. And the fundamentals, if the price drops below the fundamental values, then they will be buying. And you can see the fundamental values on your chart. Okay, so we have my market condition scans. They have stood the test of time. I wrote them many years ago because I was trying to manage the technical side of our trading floor, and Howard was managing the professional side of the floor of actually trading. And futures weren't working. They were not working. They showed what market open was, but that's about it. And so I started going in and I started designing these scans. And I said, give me all the stocks that are moving with very high momentum to the upside. Give me all the stocks that are moving to with huge momentum to the downside. Then I compared the buy side to the sell side. How many are there? And what's the comparison? So I could see the bias of the market. Is it going to go up tomorrow or down tomorrow? Broad base of stocks, not the indexes, because the indexes don't tell you much. Institutional activity, how high is it? Super high. Okay, they're accumulating. Bottoming stocks, also very high numbers going on in that particular scan that I was looking for. And then we can see consolidations. Whoa, that's off the charts. So pro traders are in the mix. We got those going on. Overbought is super low. So is RSI strength at this point when we took this snap. This is right out of the market condition scans that are embedded in MetaStock charting software, which is awesome. And I love 19. Don't you just love 19? It's just so awesome. It's really great. Just love it. And it's so much fun. So I have a market morning report that I do, and I give out my analysis so that the students can learn. And they have my trading journal that I developed years ago, because you have to have a trading journal. If you want to trade as a business and get the IRS status of that, if you're a US citizen, or in Europe, they also have it, then you need to have a trading journal and everything that documents this. And this activity tells you how to trade, tells you what the market condition is and what's going on in the broad base of stocks, that 10,000 other instruments that you could be trading. Awesome. Market conditions versus trading conditions. I need to explain this. The 6 primary market conditions occur typically in this order at the beginning of a new bull market and the end of a bear market. Bottoming to platform, controlled by the dark pools. Write that down. To moderately trending, to a velocity that can switch. Sometimes it goes velocity for a few days. Remember, velocity is very short term. Moderately trending, up trending, to velocity to topping. Okay, that would be the whole gamut of the long-term bull market. Trading range markets are a correction or a quasi-bear that moves sideways in very wide volatile price or value action. We'll cover more of this in a little bit. That means trading ranges are a continuation of the trend and result usually, not always, with a resumption of the uptrend for the indexes. They don't happen that often, but you'll find stocks that are stuck in trading ranges, and their industries are stuck in trading ranges. It won't occur much on the indexes. All stocks go through the cycle of bottom, platform, moderately trending, velocity to topping within their own business or industry cycle. Everybody cycles. They all cycle at a different time, but there is this predominance that's going on. Typically, most stocks will cycle in their own industry. So the industry is cycling. So what industries are cycling right now to the upside? What are bottoming and starting platforms are starting moderately trending for great swing trades? I love swing trading. So I write my morning market reports, and I just wanted to show you what I have for my students. So in the market condition, which of the 6 market conditions is dominant at this time? Market condition and market open reports. So what I'm going to say is market condition, the MSCI scans. I talk about the indexes and what the indexes are doing, and then I talk about the broad base of stocks. Right now, we're in a moderately uptrending market condition with the indexes in a correction mode that is sideways. It's not a trading range, but they are sideways, although the NASDAQ and the S&P 500 went up again today. So they're in a velocity action right now. Trading condition, HFT activity, how active are they? Small fund activity, how active are they? When I talk about small funds, I'm talking about that less than 3 billion assets under management. They're no longer considered by the SEC as professionals because they're amateurs. They don't know what they're doing. They have no SEC license. They don't have any, they don't have a financial services bachelor, even a bachelor's. They don't have any. There's somebody that pulled off the street and started a little fund. Dark pool accumulation or rotation. What is dominant? Are they accumulating or rotating? And what are the pro traders doing? Because you want to piggyback the pro traders. You want to hug those guys like you're in a race car and they're the lead and you're going to hug them, and then all of a sudden you're going to zip out ahead of them. Okay, you want to be huggy bear to the pro traders. MCA scans. I have the momentum scan, the sell scan, institutional, all that. I study the numbers in there and then I tell them what is going on so my students can understand. They can learn this and do this on their own. My pros and eventually leave me and work for somebody, and then they use this and go on because they're using MetaStock trading software. MCA scans interpretation, my analysis and interpretation of what the scans are indicating. I also do the bias for the day. Is it up, down, or neutral? It can be up, it can be down, or neutral. Doesn't matter what the indexes are doing. What are the broad base of stocks doing? That's what matters. Energy, is it very weak, weak, moderately weak, moderate, or speculative? Right now, we have a very weak to weak activity going on because there's a lot of retail traders and a lot of retail investors that are saying, oh, this market's so volatile. So-and-so says it's so volatile. I can't do anything. So you're just sitting on the sideline. Meanwhile, I'm seeing swing trades all over the place. How to trade. Ideal for what trading styles and which strategies for that style. You have to have at least 2 styles because there are going to be times when intraday trading just doesn't work because you got too much whipsaw action. So give it up. You can go day over day, or I would suggest swing trading because you hold it for 3 to 10 days and you make a whole lot more money. You may find this a lot easier. Professional news. What are the professional side of the market? Is hearing and reading. It is so different. Retail side, if I could get everybody to stop reading the retail news, it would be so easy. Actually, I challenge my students once in a while to turn off the retail news, turn off and don't read any of the retail and see if they improve their trading, and they always do. So economic news reports, which are critical and which are not, to the dark pools and the professionals. Oh, they'll say, oh, this is a high risk economic report. It's so important. It's only important to the retail side. Dark pools could care less. What the dark pools care about on those economic reports, plus the dark pools already have those reports by the time it gets to you. Okay, retail side is always late. You're always at least a day late. And so they're different. So I tell them which are important. And a summary and 2 charts to study for that day. I always pick 2 charts that I pick out in the evening before as I study out of my MetaStock charting software. And I pick those 2 charts and I say, okay, here you go. These are 2 charts. This is why I want you to study them. This is what they might be good for a watch list or something. I can't recommend stocks. I'm not licensed for it. I'm an educator. I'm licensed to educate. So trading condition market open report. Futures are flat, slightly up or down, or moderately up and down. That tells you how the indexes are going to behave. And so overseas markets are, commodities are, ETFs are up and down or mixed. So this is up, down, or mixed. Cryptos are, and currencies are, and bonds are. These are for people who trade these other markets that I have on my thing. It can be up, down, or mixed on any of these activities. If there's a huge down, overseas markets may be down, but it may clean out. Commodities up or down reflect for commodity stocks. ETFs are for the index stocks. Cryptos are for the BTCs and BTCs. So because we have Bitcoin and all that on in ETFs now, so you can trade the cryptos right in your MetaStock. Woohoo! Currencies, if you're a Forex trader, and bonds. Bonds often indicate that we have fear in the market on the retail side. Cryptos will tell us if we have fear of the market on the retail side. Okay, so that's what we know. High volume. So to the downside or the upside, and those volume ranges from 1 million lot shares to 28 million, and they can be even higher than that. This is a block order. Lot sizes are at, below, or above average for block. And how many block orders are there going through on what stocks? I have the list of stocks that are most heavily traded before the market opens. They are not going to change that price, but they're accumulating that because they're buying it on the penny before the market opens. So that's really important information about the market and probable HFT activity or professional activity for my traders to go out there and start trading in a few hours. I do that at 4:30 in the morning. How to identify which market condition is present and dominant. Market conditions are not just how the value of the index is trending. It is about the entire broad base of publicly traded companies on all venues, both public exchanges and the dark pool ATS venues, and so on. Market conditions vary in duration, trend, up or down, or sideways, and who controls the price. So again, these are the ones we're going to be studying today. Those are the top 6 primary in market conditions. So bottoming market condition. The bottoming market condition is exactly what the name implies. It's a bottoming market. The indexes and broad base of stocks have been in a bear market or intermediate term downtrend. There are many shapes of a bottom: bowl, rounding, triple, V, U, basing, and others that I teach my students. Now you can see that this is really volatile, but you should not be selling short in bottoms. And you want to see, oh, dark pools. Oh, here's a dark pool activity. Oh, here's dark pool activity. Oh, here's dark pool activity. Oh, and now it's above the bottom completion line. So now my swing trade is ready to go. Buy side giant institutions create the bottoms. They strike the penny. This is a wider spread than they normally do because this stock is below its fundamental values. Its fundamental values are up here. When stock prices fall below fundamental value levels, dark pools start buying bargain priced stocks. Bargain price stocks because fundamentals are above the price. And that's what they do. And if you can see that in the chart, you go, oh, dark pools. Okay. During a bottom, retail groups are afraid of the market or are trying to sell short. It's like, stop. And we'll go down more. And so retail groups hesitate and often sell at or near the lowest price of the dark pools are buying, or they're trying to sell short. It's like, don't do this. Please don't do this. This high volume is HFT, okay? Or a memes group. Since there was no gap, I would say this is a memes group, super high. They don't know what they're doing. They're trying to sell short. And of course, the dark pools are laughing. Not really, but I mean, it's kind of sad. And so they push the price up. And then they try to sell it down more. And then they push the price up. And now you got the pro traders in the mix. Okay, we got one and couple down days, but then the price goes up again. Okay, so you can see that the power of the dark pool and the pro traders with all that money is pushing that price up out of the bottom. You do not want to be doing that. You want to be with them. Retail news is full of fear, negativity, and misinformation. It gets so boring. Okay, we have a basing bottom, and that's where they're accumulating, and they're pinging on it. Okay, and then all of a sudden there'll be a small run up, and then another consolidation, which is dark pool accumulation at a higher price. And then we have more speculative run up and stuff. So you have a lot of different things to learn, and the indicators will guide you as to what's going on. And I teach what these patterns are so that you can see, because there's a springboard and there's a nudge, and you have all kinds of activity. Now we have this little volatility pattern here that is going on because somebody decided that they needed to sell. The pros are pausing and not really active during this little period of time. They got some other stock they're moving on, bottoming markets. The sell side institutions control the downside to about here. Then there will be some buy on the dips and things going on. Dark pools are getting in right here. Pro traders have a nudge, move the price up. They take their profit. It runs down because smaller funds are selling, smaller funds are selling, smaller funds are selling, smaller funds are selling, capitulation or trying to sell short in a bottom. You can't win. You know, you got a 5 million share buy and you're selling 1,000 shares or 100,000 shares, whatever, small funds. they're going to lose. They're going to lose because this stock is going to bolt out of this. Look at this nice momentum run. Boom, up. Lovely. And then, of course, profit taking. And then, of course, now smaller funds are trying to run in. And of course, then there's some more selling short. And then, boom, it's going up. This stock is completing its bottom. Okay. Platform market conditions follow a bottoming market condition. Why? Because the retail side is scared to death of the market. So they're not in the market. So the dominant player is dark pool buy zones and dark pools and buy side institutions. Sell side institutions are going, I hope the corporations want to do some buybacks pretty soon. The platform market conditions taught only in the TechniTrader courses. I developed the platform market condition, identified it. It is in the CMT. I'm presenting it so that they can be part of the CMT program because it is a new sideways trend that never occurred before. The platform market conditions started appearing in 2002 when the market switched from fractions to decimal pricing and has become stronger and stronger over the years. Dark pools strike the penny or half penny in a narrow price range, creating this newer type of trend, which is wider and longer term than a consolidation, but has very distinct highs and lows. Dark pool TWAP orders create market condition. Buy side giants create and control that platform market condition. Professional traders search for patterns, these patterns to create nudges and triggers to move price toward via HFTs and smaller funds managers. So there's the trick. Dark pools do the buy zone. Then the professional traders go, oh, nudges. Oh, HFT. Hey, HFT. Hey, this is a dark pool down here. You can gap this stock up. And the HFTs are programs, so sure, they do it. So these are platform trends that are moving up. And as the platforms move up, they get shorter and shorter and shorter, and then swing trading becomes easy. They often gap between them. This doesn't necessarily, but it is. So platform position trading can hold the stock for much longer and make much higher income. Moderately trending market conditions tend to follow platform conditions or trading range conditions because all of a sudden everybody goes, oh, the market is going up. Okay, yeah, it has been. The moderately trending market has a steady uptrend over many years and show up during the middle years of a long-term bull market, usually, sometimes earlier. Frequent minor to intermediate term corrections are common and maintain the integrity of the uptrend over many years' time. So it's not just up, 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 up. There's going to be minor corrections from time to time. That's what we have right now. We have a moderately trending market that's just correcting a little bit. It's fine. It's not the end of the world. This market is dominated by the professional traders setting up triggers that initiate HFTs, smaller funds, and later retail traders and retail investors who always buy late. So momentum is reasonably stable for swing trading, momentum trading, or platform position trading is very common. These are the best for day trading. It may be very volatile. It may be very volatile for day trading. So I recommend, again, I know some of you love the day trade, but when the momentum is there and when the velocity is there, that's when your best activity is. Retail groups often mistake minor corrections for the start of a bear market. Oops, can't sell short in a moderately trending market. So this is a basing bottom to a moderately trending, uptrending market with some corrections. And you can see that the dominance of the upside is present everywhere in this chart. And there are smaller funds trying to sell. There's memes groups trying to sell down, but they fail. Oh, memes group, sell, sell. Oh, no, you're not going to do that to the stock. Oh, sell, sell. And the memes groups lose tons of money. And the SEC is investigating most of those memes groups. So if you're part of it, be careful. The velocity market condition is the shortest of all the conditions, lasting a few days to a few weeks, intermittently during a bull or bear market. Velocity, like moderately trending, can be either up or down. So you have this velocity run up. We saw NVIDIA have some really great velocity runs. Velocity uptrending market conditions occur when the retail traders, retail independent investors, foreign funds, and sovereign funds are buying speculatively. They've been watching this stock and they've been watching NVIDIA and now they're going, I need to get into this stock. It keeps going, it keeps going, it keeps going, it keeps going. And irrational exuberance takes over. That's great because you can get in early with the pro traders nudge right here and then ride these up. And then when the pro traders exit, get out, wait, another nudge, run it up. It's a very simple format, and it's better to do the swing trading than day trading because you make more money. These groups control the velocity runs, which are often have no overlapping candles. I couldn't find any no overlapping candles for this particular one, but I can find some later, of candles as price trends to open up or slightly above the previous day's high due to the rising overnight order flow from the retail group. So the retail group see NVIDIA rise. So the next day it gaps up just a little bit and then it runs up. And so they're doing this with the overnight order flow. And by the way, if you have overnight order flow, if your broker allows that, we all can see that because the SEC requires that brokers be fair and light their orders so that everybody knows what's going on the retail side, and they can't fudge on the retail filling of those orders. The angle of ascent warns traders that the trend is too steep to sustain. Physics, guys, physics. If the run is vertical like this and it's going up and up and up and up, it's going to go down really fast at some point. So watch what the pros are doing and get out when they do. Professionals always sell with great care, creating tiny resting day or profit-taking day candles that do not move price down much at all. So this is a velocity market down, and this is a velocity up. This is just a pattern on one stock chart. But when it's a velocity market, you'll see the Dow and the NASDAQ and the S&P also, particularly the NASDAQ, because we're a new technology bull market. We have 20 new technologies coming to market in the next 10 or 20 years. Oh my gosh, it's so exciting. I haven't been this excited about the market since the 1990s. It's like, are you kidding me? This is going to go for a long time. This bull market is going to last for a long time. So you want to learn the velocity. Well, the velocity runs often don't overlap at all and have no wicks or tails. So the trading range market condition is the most challenging market condition to trade. It can develop on the intermediate term trend or the long-term trend. So it can be something you see mostly on weekly charts. The longest and worst trading range market for the indexes started in the late 1960s and ended in the 1982. It was a very long trading range market. It was horrible. We had inflation that was out of control. Gas went from 35 or 50 cents a gallon to 250 cents a gallon. Everybody started buying small cars. Leveraged corporate takeovers and skyrocketing in inflation everywhere with oil prices soaring are the cause of such long trading range market conditions. We don't have that condition. Everybody's whining about the inflation rate. It's like, get over it. When in the 80s, if you wanted to buy a house, your 30-year mortgage cost 12 to 15% mortgage interest rate. It was a killer. Also, there are no new technologies of significance during that era. There weren't any new technologies until the Japanese created a little small car, and then they grabbed it because our automotive companies said, "Oh, nobody wants to drive those little tiny cars," but they did because they saved on gas. So nobody wants to buy EV cars. Nobody wants to buy EV cars. Trading range market conditions occur from time to time and usually are a correction phase on the long-term uptrend that is very wide. Special training is required to profit from a trading range market conditions. They're really tough. Most of the time, what we do in trading range market conditions is we find industries that are trending up or down. So this is a trading range condition that is very up and down, and it's very tough because you have all this intraday support and resistance factors, and these runs don't go up very easily or very well. The topping bull market condition occurs at the end of the bull market. The great bull markets of prior eras, and there were only two, were 1929 and 2000. We're due for a new one. This is the NASDAQ topping great bull market of 2000. See how long this baby ran, and then it went velocity. Oops, 55% loss. 1929. Oh, mutual funds. Every middle-class American bought mutual funds, and it went up and up and up and up vertically also. And then it crashed because there were no curves or buffers or anything, and it dropped 82%. We don't have that kind of losses anymore on the indexes. We do on stocks. Both great bulls occurred due to the numerous new technologies of those eras, all coming to the consumer market and small business market within the years of those great bulls. What is important in a topping market condition is that all of the retail side of the market ignore the warning signs. All of the retail groups believe the market will go up, and speculation has become irrational exuberance and euphoria. When everyone thinks that the prosperity will go on indefinitely, that is when well-educated traders and investors start selling their stocks, as a great bear market always follows. So this is a topping market condition in an individual stock. It has a lower high and a lower low. This is a topping condition. It can find support here, here, or here. This is where it will probably start, because this is where the fundamentals were before it went speculative. Okay? So market participant groups, you need to learn why and how each of the 12 market participant groups affect price and volume. I can't teach that today, that I only have an hour. So each group has a distinctly different footprint on the stock chart. The size of the candlestick, where it forms, whether it has wicks or tails or not, tell you who controls price at that time. I teach all of this in my courses. Within each group, the trading activity is very similar. So each group trades very similarly. The giant dark pools, the 20 to 25 of them, all get in about the same. You must understand the wide disparity between the groups in terms of venues. Are they trading the lit public exchanges or the dark pool venues, or buying directly from the company? Lots of times the buy-side institutions are buying directly from the company. What order types do they use? Dark pools use TWEPs. Smaller funds use VWAPs, the most dangerous order on the market. Why? Because the more volume it is, the faster the VWAP works. That's what's caused these flash crashes. Access to information, lot sizes, and intent of the trade. Long-term, short-term, what is it? Over the past few years, the financial markets, especially the stock market, have fractured into a multi-venue structure that has never existed before. We're a digital economy now, folks. So we got to stop looking at consumer economy and all of this and start thinking digital economy, because the middle class of America and of the world needs our stock market and all our other markets to succeed, because that's where the money is. Relational Technical Analysis, which I teach, makes it easy to recognize each of the market participant groups' footprints in the chart. So I teach this in my courses. Instead of thinking in terms of volatility, consider using market condition and determining which is the dominant market condition for the broad base of stocks. The indexes Dow 30, NASDAQ 100, and S&P 500 often have very different trends from what trends are developing in the components themselves of those indexes and the broad base of stocks. We have a lot of stocks moving sideways right now, but they're not volatile. A lot of them are potential swing trades, and there's some platform position trading. This is because an index is a composite of many different trends combined. The primary market condition will have the majority of stock trending the same way. Industries tend to group together also within sectors trending similarly. So there's sectors, and within each sector are lists of industries, okay? So a sector might be real estate, and so there'll be industries of the real estate market, or there might be a sector for technology, and technology within that will be all the industries, semiconductors, software, so on and so forth, in internet and all that stuff. So when retail news calls the market volatile, ignore it and find the trend that best suits your needs and your trading styles and what you can do. Because if you find the trends and you understand what industries are still moving up despite the volatility of this market, you're fine. So we have many courses that you can check out at my website if you would like to just do that. And I would recommend Trading a Professional Plan or Leading Candlestick Patterns. That's always good. We also have Trading as a Business, which is really important. I have a lot of people coming to me to learn how to trade as a business so they can have the IRS status and work as a business, as a small business, but have all the advantages. All of your MetaStock charting software is deductible. Woo! All of your courses are deductible. all of your expenses, electricity, water, your computers, all of this is deductible. And you can take, if you're not a hobby trader anymore, so the IRS and the professional side respect you. So trading as a business is a big deal. So if you want to check that one out, that's really good. Now, today, so if you're ready to take the next step in your trading career, I want you to call 888-846-5577. I have a couple of my curriculum advisors waiting for calls, and they will talk to you and explain the 3 different levels that we have. We have 3 methodology courses, and a lot of you might want to do the elite, but it's at a special price for this day only. For those of you who took the time to come here, who took the time to sit through all my blathering and excitement. And so if you call, then you can talk to them and set it up. Or if you don't want to call, sign up to see the inside of the TechniTrader's Elite Trading Methodology course. So you visit this. So if Jeff can put this into the chat, I would appreciate it. Or if you can get this little symbol off. It's good for 1 week or only, and it's only for MetaStock attendees of this webinar. So that gives you an opportunity to have more interest in what we're doing and what we're doing at TechniTrader. We have a huge number of tools, scans, market condition analysis, and everything else in the TechniTrader courses that we've developed around MetaStock. MetaStock is just an amazing company, and I'm so proud to be part of it. So I'll take some questions now.
All right. We did get the links posted in the chat for you too, both YouTube and in GoToWebinar. Earlier, we were talking about volatility and the fact that VIX had gotten too volatile, which is kind of a funny way to put it. But like, Reg wanted to know, would part of the issue with the VIX be that it's gotten much more tradable than in years gone by? Do you think that has an impact?
Yes, definitely. You are correct. You are definitely correct. It's much more tradable. And they have VIX ETFs, and they have VIX all over the place. There's have things that you can trade the VIX. And so, yeah, so the volatility has increased. But examining it in terms of the S&P 500 is what I was trying to present today. It's not representing the S&P properly. So I need, that's a very important thing when you're trading stocks or options or something like that.
Very good. Let's see. Also, let's see. The lighter side had a comment and also a question. So her comment was, oh, actually, it scrolled off. Hold on. Just let me scroll back up to it. It's so good. Thank you for the clear and easy to understand explanation. Her question was, how can I become your student?
Well, why don't you give us a call today and talk to the curriculum advisor. They're not your typical salesperson. They're not going to push you into anything, but they can explain and go through. They can take you through the course, you know, and talk about it and find out what your needs are. The thing is that I don't do a hard sell because I need to know what you need. So you need to tell us what you need, and then I can show you. I have actually 48 courses I've created, but you need to start with the methodology course. But this course is amazing. Howard and I created it, and it is people who looked at me for 10 years and they go, finally bite the bullet and they say, well, I'm going to take her course because I'm just desperate and I've lost so much money. I've spent hundreds of thousands of dollars on other courses. Nothing works. And then when they get there, they go, oh, Martha, why didn't I take your course before? This is just amazing. And I teach professionals and they go, I can't learn this. I can't even learn this on the trading floor. So it is really important. And I have more and more people who are becoming, I have one who became a hedge fund manager for $100 million hedge fund. I have others that are overseas in Europe that have prop desks that they're doing. So you're getting an education that you really can't get anywhere else. I've gone through a lot of the other courses and they're not anything like what we have. It's hard to explain the difference. It's like trying to explain the difference of MetaStock charting software. It's so awesome and so full of stuff. I mean, every time I go in there, it's like, oh my goodness. It's hard to express how unique MetaStock is. It's hard to express how unique TechniTrader is. It just is. It's hard. It's hard to compare it because it's so different. So give us a call.
You can keep going on how awesome we are. I'm just kidding. But I appreciate the
Every
sentiment.
time you do an update, it's like, oh, all right, that's so cool. I know it's going to help my students.
Here, I was asked a question earlier. Do you think AI is going to have a big impact on kind of the way the way trading works in the next 5
It
to
will
10
not on the professional side for a very, very long time. The SEC has slammed the door on that and said no, because AI is unpredictable. It is not accurate. It can cause all kinds of problems. In fact, the SEC is investigating that crazy action on the New York Stock Exchange the other day when GameStop and what was the other companies that crashed? A big name company.
Was it AMC?
It was, Berkshire Hathaway.
Oh,
Yeah.
gotcha. Yeah.
9% lost 90% of its value. I was like, okay, SEC is going to investigate that because that's pretty weird. That's not a common stock that retail traders would do or something and stuff. They're investigating that quietly. They're doing it. They're always quiet. I've been in a lot of SEC meetings and things because they ask the CMTs to come in and give their opinion of things because they're important to them. And I know they're investigating that to see, and if they catch whoever it was that did it, because it wasn't, they calmed everything down because they said, oh, it's a technical flaw. Well, of course it was a technical flaw, but somebody caused it. Somebody did it. So they're not going to have AI. The SEC says, nope, I'm not going to do it until we can see what risk factors are, because the risk factors are that AI could cause a meltdown. SEC doesn't care if prices go up. They're fine with that. But when you start messing around and you start having a situation where you are trying to manipulate the price of the market to go down, that CEO got fined by the SEC for recession stuff, but nobody knows about it except the professional side. They didn't publicize it, but when you're pushing the market down, the SEC gets all upset. That's why the dark pool support the market is okay, because the stock goes down or something, or the indexes go down to 20%, and then they buy to support. The SEC says nothing. That's okay. You can do that. Yeah.
I want
AI,
to kind of reiterate.
For the retail side, the retail side thinks that it's a magic bullet and it will tell them what stocks to buy. But all the AI that I've studied so far is just red light, green light. Doesn't work.
Yeah. I wanted to reiterate this sentiment because I kind of was a little bit cheeky and like, yeah, we love MetaStock, keep going. But I do want to just kind of express the thought that over the years that we've worked with you, and I swear it's been decades by now. Everybody that I know that's involved with TechniTrader is happy with the experience that they have. The Better Business Bureau ranking's a huge thing. It's really great to work with you, Martha, and we're proud of our relationship with you guys as well.
Yeah, no, it's a great partnership for the two companies to work together. I remember when we used to do hotel rooms, and that was always fun.
That was fun. Yeah. Okay, well, 800-846-5577. A lighter side, I know you're in Europe, so you can go to the link that we provided in the chat room, the ttrader.im/M60624. If you prefer to call in, do you have an international number that you've got memorized that we can give?
I don't, but if you if you register on the site and then say I want this, then I can get an international call for you. I know we have one because we have internationals calling in and we talk to them, but I don't have that off the top of my head.
No problem. Lighter side said also as a question, what are promising sectors? Is there any sectors that you kind of see as outperforming other sectors or anything like that?
Okay. I have 20 new technologies that I've actually done courses on that are coming. The sectors that are really important are the technology that is just starting with the AI, and that's the new technology for the internet, for software, for semiconductors, chips. All of that are going to be changing. We've got the robots are coming. They're already here. Robotics, because we don't have in America, we still have 8.8 million job openings That's why I say there's no way to have a recession, because we have more job openings than people. Corporations like Amazon aren't going to put up with the fact that they can't find people to work. They've already started building their own little computers, and robots and robotics and stuff are taking over their things. So that's coming. There's 20 new technologies, and if you register on our website and ask, I'll send you the list of those technologies, and just email it to you. I'm happy to share those with you.
Cool. Yeah, also, I did go to your website. If you're calling from overseas and you want to get a hold of TechniTrader, you can call them at country code 1-253-351-2979. So there you go. All right, Martha. I think Maverick says thank you, Martha. Very informative as always. I'll also say thank you. Thanks for joining us. I hope you're enjoying summer. It's my favorite season of all of them. Thanks for joining us and spending some time with us. Appreciate you.
Great. Have a good day. I hope you learned a lot, guys. Bye.
Bye. All right. Thanks, everybody. Before you leave, be sure to like and subscribe. It helps a great deal. And we'll see you at the next one. Thanks for coming. Thank you again.
Hi, Kelly Clement here from MetaStock. Before you go, I have two quick things for you. One, thanks for joining us today. We love having you here at our webinars and viewing our videos. So what I'd like to invite you to do before you go is like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. The second thing is we have a great ebook on trading that you can get for free. If you go to metastock.com/YouTube book, you can get a free copy of The Secrets of Successful Traders. It's a great book with lots of content from traders just like yourself who can teach you some of the secrets that they have learned. Thanks for taking a second with me and learning about those two things. Thanks for joining us, and keep on trading.